If you want to know how to make a 30% return on your money while only having a 30% chance of being assigned shares in the stock market, this video is for you. Hey, what's going on, everybody? Andrew Ferguson back here with another video showing you how you can use stock options to invest your money and grow. In today's video, I'm doing something really cool. I'm going to break down in live time how you can save and invest your money to make 30% returns in the stock market while only taking on a 30% chance of actually having to buy shares. What am I talking about? It's called stock options, and here's how it works. Right now, we're in the Interactive Brokers Trader Workstation for your desktop computer. And what I'm going to do now is open up the Disney tab here. And this will show me things like the Disney chart down here. It'll show me things like the Disney option chain over here, which we're going to use in a second. But just to identify this is Disney. This is a stock that's traded on S&P 500. What I'm going to show you right now is how you can make a 30% return making a simple trade with an options contract here on the put side with Disney. So if we look at the chart here with Disney real quick, we can see that's kind of been trending downwards. We don't want to buy it potentially at $92. What we want to do is go ahead and pay a little bit less than what it's trading at today, and then go ahead and buy it maybe down here around this 80, 89, 88 kind of range, kind of where it's touched before. So to do that, we go into our options chain here, and we have the different kind of expiration dates at the top, and I'm going to go 2 weeks out. So for 2 weeks, what this means is that in 16 days, this options contract will expire. With all options contracts, they have an expiration date. And this isn't a kind of a tutorial of what option contracts are. I'm assuming you guys kind of know that already. If you don't, check out this other video in my playlist here about how stock options work and check it out right there. But if you have an options contract for Disney and you go into the 88 range right there, what it's saying right now is that you can buy this or sell this contract, sell this put contract at $88, and we get paid around 122, 124. So let's call it in the middle and say 123. And so if we were to sell this contract, right, we go and make it red, we'd sell an options contract of Disney, quantity of 1, because every contract is 1, made up of 100 shares, don't forget. And 123 is our final kind of price. We would go then and click the advanced button here in Trader Workstation, check out our margin here. It would cost a little bit of margin to do this. We override transmit, and boom, our order is in here. And once it gets filled, it's going to go ahead. I'm just going to change it down to 120, and we'll go down here and make sure it gets filled. Okay, so now it's filled. We have an order in here. If we go into our portfolio, we have an order here of 120 for Disney. It is right there, January 20th, 23, $88 put. It's currently down, but we got paid 120 to sell that put. So what this means, okay, what this means right here is that we got paid money to sell this contract, and how you make your 30% returns is like this. So what we just agreed to do again is to buy 100 shares of Disney at $88, right, per share. Remember, right now it's currently trading at 92 bucks. That's even a discount on the current trading price, which is a good thing. But what it's going to cost us if we end up having to buy those shares is 8,800 bucks in capital. That's what we have to actually purchase those shares with if it expires underneath $88 and Disney shares drop. If it doesn't drop, we just keep the money. And the money we're talking about is the premium that we got paid. So that $1.20 that we showed on the screen before, that's roughly worth $120 in actual premium because every option contract is made up of 100 shares. So we go 1.2 times 100, we get that nice $120 return in premium. So now, you get the math point of it. We make 120 in our actual kind of premium, which is stuff we put in our pocket for making the trade. It potentially costs us 8,800 bucks to actually make this trade and buy those shares, which gives us a 1.3% return. And again, the title of this video is 30% return to the market. So what we have to do is remember that this contract is only in place for 16 days right here, which means that you can do it for 16 days and then do it again, right? And then do it again, and then do it again every 16 days. And roughly 16 days is about half a month. So we can say that we do this about 24 times over the course of a year, assuming we don't have to ever buy the shares, which gives us a 1.36% times 24, giving us our big boom, 32% return on an $8,800 investment. Might not seem like much. When you take 120 and multiply it by 24, let's bust out the trusty calculator right here and get that going, right? 120 times 24, boom, 2,800 bucks for the year, right? We're looking at 2,800, 2,880. And the best part, you have a 30% chance at this moment in time of actually being assigned those shares. So a 30% chance of having to buy the stock at 8,800. The rest of the time, 70% of the time, you don't have to do nothing. You just get paid, just get pocketed this cash here, and you're good to go. But now, if you want to make more than 30% with options, this is how you do it. Let's say you want to make something around 50, 60, even 70% with options trading. This is how you can go ahead and get it done. We're going back into our portfolio, going back into our options chain here, but we're doing a different company here called Tesla. Maybe you guys have heard of it. It has been in the news recently. It's gone in a kind of a crazy kind of decline lately. But let's say you don't want to buy the stock there at 113. You want to buy it at a different price. And at what price do you want to buy it at? Well, how about we go and look at it in the realm of maybe 105, maybe, right? 105 area down here. Okay, give us a little bit of a buffer in case the price decides to drop again. Hasn't been down there at 105 in a long time. So let's go 105 and see what that looks like. And if we go into our actual options chain, same expiry date, 16 days in the future. Okay, look at the same thing. We go down to the 105. So you have to scroll down a little bit here, right? Scroll down, scroll down, scroll down. Give us some buffer. The 105 area right here. Okay, we've got a delta of 29, which means we have a 29% chance of getting assigned shares here. And we also have a bunch of premium coming in right around 3.8. Let's call it 385, okay, for this options trade. So if we wanted to do this, again, we'd sell an options call, sell a put option. So if we wanted to do this, we would click on here, boom, this pops into the top. We would sell a put option on Tesla. Again, one is 100 shares, so one contract. Let's go 3.85 just to make it fill right away. Day advance is fine. We're going to get a little bit into our account. We also make sure that we're always getting paid here, which means money is going into our account, okay? We're going to transmit this. And as soon as this fills and we lock this baby in, we are going to have a $385 premium position in our account. And that is going to look something like this once it goes in. Again, we're doing shares of Tesla, right? We have 100 shares at 105 was our strike price. So that's going to potentially cost us $10,500, just doing the math there, 100 times 105, right? 100 shares per options contract. It would cost us roughly $10,500 to buy 100 shares of Tesla with our options contract the way it's structured, which means we receive 385 times 100 shares, which means it's 385 in premium in our pockets, okay? And the return on that is 385 divided by 10,500, which is a 3.67% return. Again, because this is only in force for 16 days right here, we can multiply and do it again and again and again, roughly 24 times over the course of the year, giving us that nice equation down there. 3.76 times 24 equals an 88% return in straight dollars and cents. If you want to do it, the math, 9,240. That's your profit on this trade, which is almost, like I said, almost the initial amount that you made in your initial investment. So if you can keep doing this trade over and over again and not get assigned, you're taking home big bucks. And you're doing that again with a, if we recall, a 28% chance of being assigned versus a 72% chance of not being assigned shares of Tesla. So that's how you make big time returns in the stock market with stock options. If you want to know how I actually go and choose the actual strike price for my stock options trading, check out this next video here. I'm going to go through the chart showing you exactly what to look for, support and resistance lines and different kind of trends and indicators that I use when I'm making my stock options trades, and how I actually go about setting the targets and the kind of the applicable zones for what is a good return versus a bad return, and the actual 25, 30, 35% buffers for getting assigned, not getting assigned, how I all set them up in this video coming up right here.